Hello, welcome back to the MCR Accounting Financial Literacy Series. This will be episode 3, I believe. And today we're going to talk about something that's a little bit more all-encompassing than our last episode. I think this is going to affect more or less everybody. I'm directing, or where we at MCR Accounting are certainly hoping to make the biggest impact on younger people, but there will be things in here that are a lot of fun for, people that reach the hairstylist age that I am at. So we want to talk specifically about TFSAs, and we want to talk specifically about RRSPs. Before I take you there, though, I want to put things in some context. This is the way that we feel that you should be thinking of these things. They should be a part of your personal retirement service. And the time to start thinking about this is basically at the soonest possible moment. So included in your personal retirement service is RRSPs and TFSAs, the things that we're going to talk about today. Also included in there is the Canada Pension Plan and Old Age Security. And whatever, and I'm putting it down as company pension plans, but there is such thing as private pension plans. All of these things together represent what your financial health is going to look like in your retirement. So here's how it breaks down Canada-wide. And to be clear what this graph is showing us, this isn't what an individual retirement income would look like. This is what the collective retirement dependency for the country currently looks like. We checked this data this morning. It is still relevant. So the first thing we'll deal with 20% of Canadians' retirement financial dependence is focused on the Canada and or the Quebec pension plan. That's a good thing. Nothing wrong with that. That's one of the benefits of living in a nation that has a national pension plan. Almost 30% of people's retirement dependency will be based on pensions and RSPs, and there's various different variations of those combinations. That would make up another 30% of our dependency. The number I want you to take note of here, though, is this 27% for old age security. And the point I want you to keep in mind as we work through our talk today is that old age security in this country is intended to be a social program. The fact that 27% of Canadian retirement income dependence relies on old age security is a scary thought. And probably, old age security is going to be 100% clawback for me. It could be 100% clawback for most of my little circle. But if I look at this number here, I can tell you that is not true for a very large segment of our country. And we want to try to help people address this, because that's not a comfortable place for people to end up. So did you know, I didn't know this. I had Christina check this for me because the slide deck I'm using for this presentation, she presented quite a long time ago in a community financial literacy club. 28% of people over 55 have no retirement savings. Like, I just don't even know. I'm just astounded by that. It isn't even the scariest thing I'm going to show you here. So the first part, women are less prepared for retirement than men. I don't think that comes as a shocker. Although we've checked and these statistics are current and valid, the age of wokeness won't have had a lot of impact yet on this kind of data. So let's look first at the top piece, this 38% or 30%, depending on how you want to look at it. That's people with zero retirement savings. And when we're talking about retirement savings, this is like your pension. Anything that's not a part of CPP and old age security is what we're talking about. Right? So it can include your pension plans, it can include your RSPs. All these numbers are scary enough, but take a good look. What you see what this says here? People that have less than $10,000 in savings after 55 years old. I'm going to propose that we're going to add this 38 to this 25% because, what's $10,000 in your retirement savings account? That's, if your car breaks down, I guess that's a down payment for a new car. If you had to replace a major appliance, I guess you'd be okay. But you're not creating a RIF to supplement your Canada pension plan or take away your dependency on old age security. That's for sure with that kind of money. And then even look down here to this next section. If you come over here, that's people that have less than $50,000 in savings. And you know what? I don't want to make anybody feel bad about that, but even $50,000 in savings, you're not talking about something that's going to riff into a payment plan that's going to be a big help to your lifestyle. So I'm gonna propose that for the purpose of this discussion, we're adding this 11% in here. And what are we left with? Just eyeball only, we're looking at about a third. A third of Canadians are going to have income in their retirement that's not 100% dependent on old age security and CPP. A third. We are one of the wealthiest countries in the world, people. I'm not proud that the vast majority of our people reach my age and older and are finding themselves dependent on social programs. And the only way to fix that is right up front, and it involves other people. We'll bring this chart back again, right? Yes, there are people doing very well that have huge investment incomes. They're going to be in this third that we're talking about. We're not going to be too much. Look at this 6% in the red here, right? This is income from employment. Now, some of those people will be people like myself that just need to be doing something. But the sad part of it is, these are people that should be retired that can't afford to be retired for the most part. So how are we going to fix all this? Well, through savings. The sad fact is that no matter how you go about it, your only comfort in retirement comes from what you've accumulated in your working life. And the very unfortunate part for most of us is that accumulation does not take part, does not initiate itself. So when you're my age, if we look up here in the no control vehicles, that's your CPP, your government pension. I'm going to say we're going to include old age security in there, even though it's a social program. And employer-defined benefit pension plans. Now, if you're in my age, that was a be-all to end-all. My father very much pounded it into me that, a very good way to plan for your future was to work in a fully pensioned profession and own your own home when you retire. So that wasn't that bad of advice, and it wasn't that difficult for me at my age to follow. But I'm telling you, employer-defined benefits pension plans are not yet a thing, completely the past, but not something that I'd be strongly advising my kids to hold out for because they're just not that common anymore. Some of it's for good reasons. Most people that have pension plans now are finding themselves in a defined contribution pension plan. Now, employer accountability for funding these plans is less than it was in the defined benefits plan. But on the other hand, the control you and I have over what's really our money, because don't fool yourself, all of these plans are taken from your earnings either way. So it was a popular move because it gave people more, input. People like to have some input, and it's not a bad thing. Individual pension plans, they can offer you There's a variety of companies that sell those kind of things, and I don't know exactly what percentage of people would be using them, but they'll also be offering you some level of control. And then there'll be a number of investment vehicles. Perhaps your family, maybe your parents gift everybody in the family with Canada Savings bonds on an annual basis or something like that. That's something that you sort of have control of, but it is semi-locked in. So now, what do you have full control of? You have full control over your personal savings. You have full control over your RSPs, and you have full control over your TFSAs. And of course, you have full control over all non-registered monies that you have ownership of. And that brings us all the way around to why we're here today, why we want to talk about, TFSAs and RRSPs. Because this is the saving vehicle where you are 100% in the driver's seat. And now I am primarily speaking to younger people. By the time you're frequenting my hairstylist, a lot of what I'm going to talk to you about today is kind of past its prime. Although, as I promised earlier, there are some really cool things in here that I find quite enjoyable that I'm going to share with you. So even if you are more, tending towards my age, stay with me here. There's some fun stuff in here as well. So, did you know that RSPs have existed since 10 years before the Canada Pension Plan? I absolutely did not know this. I was taken aback, but it's the truth. They were created in 1957. And another thing that I was unaware of is the Canadian Medical Association had a large degree of input into creating the RSP system as we know it today. And this is because back at that time, and this would have been what was driving my father's advice to me too, company pensions were a considerable asset for the working people, and many of the more professional people could see that some sort of enforced retirement savings plan was probably in their best interest. So that's all pretty cool. And what it means is you can think of your RSP like a personal pension plan, because that's exactly what it was created for, right? But nowadays, it can also just be a supplement to a defined contribution plan, for instance. It may, in fact, figure into how you decide to set up your defined contribution pension plan, because money that you put in that way, admittedly, is most likely subject to the convenience of payroll deduction, but perhaps doesn't give you the same kind of investment control that a self-directed RSP would. So you have, in this day and age, the option to do both things. Let me get this clicking again. So what is an RSP? Well, an RSP is actually a trust fund. It's registered with the Canadian Revenue Agency, the CRA, and it's primarily used to make sure that you're not dependent on old age security when you reach retirement. So I want to say RRSP contributions are tax deductible and taxes are deferred. I've highlighted that. I want people to keep that in mind as we work through this. Taxes are deferred until the money is withdrawn. So I think some people get this and some people are still struggling with it. An RRSP is not a tax haven. It's not a tax shelter. It's a tax deferral. So what does that mean? Well, if I defer a portion of my taxes up to the legal limit of my RSP for 20 or 30 or 40 years of my working life, and then I enter into a period in my retired life of much reduced earnings, then when I pull that money back, I'm not giving them back the tax I saved when I put it in. I'm giving it back the tax I would owe at my new marginal rate. Now, clearly, understanding what I just said means that when you are young and investing in your RSPs, I am somewhat asking you to bet against yourself if you want to look at it that way. I don't know how many other advisors besides MCR are putting it this way, but that is honestly what you're doing with an RRSP. You are betting that your income potential when you're my age will be considerably less than your income potential was prior to this time in your life. And if all that turns out to be true, then the RRSP turns out to be golden and everything's good. If, on the other hand, you reach my age and you're still in the same marginal tax rate you've always been in, then there is no actual tax sheltering at all. So this doesn't affect you when you're my age yet. This won't affect you until you turn 71 and you get punted out of the RRSP program. And if your income is still at that top marginal rate that you've been at all your life, then I'm just here to be honest with you and tell you that that money is going to riff out automatically. It's going to be added to your income, and you won't in the end, if your marginal tax rate has never gone down, you won't in the end save anything. Does not mean that I or anybody else would be advising you not to participate in this. You want to bet against yourself while you're young, because the vast majority of people will have a dramatically reduced income profile as they approach my age. That's just a statistical fact. So you want to set yourself up so that when that happens, you're okay. But you also want to accept that if your life is so successful that the tax savings didn't work out for you, that's not something to be upset about. That's good for you, man. That's great. You've done good. So the best things you can do with your tax return when you're putting your money into RSPs are as follows. So first off, reduce your debts. So I'm not necessarily speaking about your mortgage debt or your longer term debts in this case. You would want to talk to your own financial advisor to see what the best way to approach that is. But certainly short term, high interest, credit card debt, short term personal debt, it is your priority to get rid of that. A cautionary note here though, because I see it all the time, and in the accounting business, everybody sees it all the time, is we give that advice to people and then they're chronically year on year still in the reducing their debt stage. So somewhere along the line, you're going to have to draw a line in the sand, right? So another thing that's very good to do is invest in long-term savings. And one of the places long-term savings, as we go further into this presentation, could be directed, invested, and self-directed, would be in your TFSA. Again, we're primarily trying to speak with younger people here. One of the investments in self that all younger people should be focusing on is in personal education. So that is a completely valid thing to be spending your tax returns on. And again, you could also just be plain up investing for personal objectives. And, basically here we're talking about things you want to do and it's your money, so go ahead and do it. But these might be in the category more of things that your mom's not going to necessarily approve of. And that's okay too, because who needs to do everything just because their mom approves of it? So what is a TFSA on the other hand? A TFSA is an entirely different vehicle, and this is part of the reason why I'm doing this presentation today. Is when I'm looking through MCR's past financial literacy presentations, this stands out to me because I'm still not convinced that everybody understands completely what a TFSA is. A TFSA is an account that does not charge taxes on contributions. Yes, you have to use after-tax money, so you're not getting a tax saving like you do on your RSP. It's not going to increase your return the following year, for instance. However, any money you earn in that account is tax-free forever. Any dividends or capital gains that you earn in that account is tax-free forever. Now, any of you that have dabbled even briefly in investing know that capital gains can attract quite a lot of tax attention. If your trading account is within your TFSA, they attract no tax attention whatsoever. And here's the key point. When you withdraw this money, this is tax-free money. Now, I promise you there's some fun things you can do here. So this is more for people in my age group. And, you know, there are maybe younger people that are far enough along that they can do this too. So you take your tax return money and you put it in your TFSA, and you manage your TFSA as an investment account. And then you take your earnings from your TFSA and you put that tax-free money back into your next RRSP investment. So now you're offsetting taxes on money that you owed with money that doesn't owe taxes. So that's a fun thing that I enjoy doing. Another fun thing you can do with your TFSA that takes a little bit more discipline, but I was very successful with it myself this year, so I'm going to put it out there. You know, I call it the Warren Buffett principle. I think that's probably, I'm at very big risk of being misquoting here, but it's when your investment accounts and your RSPs, or wherever they are, but for our purpose, they're in your RSPs, are taking a beating like they did in the spring. What a lot of very well-to-do investment people will tell you at this point in time, you don't sell everything off, right? The idea is not to sell low. What you want to do, if you can, is invest further cash to bolster those investments that you know are sound, but are just currently suffering because of, well, in this case, it was the plague and everything that's happened since. So the hard part, I said it takes some discipline. The hard part is currently, and probably for the foreseeable future, cash money isn't really doing any work. I suppose if I had millions and millions of dollars, the 0.75% or whatever cash money earns would add up to something. But for the most part, for me, money sitting in a cash account I feel like it's kind of being lazy, right? The money's being lazy. So I've had to resist that. This year, however, I was quite fortunate in that I was doing a better job than normal at resisting that. And when everything went south in February, and the bottom dropped out of a lot of very sound dividend paying, most of my portfolio is made up of stocks that will never go down and stay down. So I was able to do that. I was able to use my TFSA and reinvest money back into the very things that I had just lost substantial amounts of money on. And no word of a lie, in a 6-month period, I made 128% on that money. And then pulled it out, claimed my profits. That's the other secret to investing, is if you make 128%, count your blessings and reinvest it somewhere else. Don't hang on for 228%, because things do go up and down, right? So that's my story of how I use the TFSA. It's a fun thing to be able to do when you get to be my age. It doesn't apply as much in terms of younger account management, but it's something to look forward to. If you do everything right, you'll be able to play games like that. I want to keep emphasizing TFSA is a tax shelter. It is a genuine tax shelter. And here's the reason why I don't think Canadians are getting this yet. Because I can still sit in a coffee circle and hear people go on at length about, oh, if only I had offshore accounts the CRA didn't know about to keep my investments in, then I would be able to do just as well as the, mythical 1%ers. Well, let me tell you, your government gave you that account quite some time ago. It's been accumulating overhead ever since. And if you really want to do that kind of tax sheltered investing, why aren't you doing it? Right? Because you don't need an account in the Cayman Islands. You can do it at the Royal Bank of Canada. So I'm expecting that right now there's a bunch of people shrieking at the top of their lungs, Pete, Pete, that's registered money. That's money I have to tell the government I have. And yeah, you do. It is registered money. I'm not really sure why that's a big concern for you, but let me tell you the advantage of registered money. When I pulled those earnings out of the account that I told you about and put them into business expansion in my company, I didn't have to figure out any sneaky ways to reintroduce that money into my Canadian accounts. It was registered. The government knows I legitimately made those tax-free earnings. They don't have a problem with that. So, you know, I think it's more a case of trying to keep our paranoia that our government hates us at bay. The TFSA is a tax shelter. By any other name, it's a tax shelter. And there is no advantage unless your TFSA is absolutely maxed out. I can't even fathom why you would go through the trouble of opening an account in the Cayman Islands or any other such place. You're not going to gain anything, and you're going to lose the ability to freely use your money without having to be sneaky about it. So when should you be using an RRSP? Well, plainly the main objective is retirement. Right from 1957 on, that's the RRSP is intended to be your retirement plan. So that's the first time you'd use it. Of course, it would have to be RRSP room available. So if you're already maxed out, then most likely I'm not telling you anything you needed to know anyway. If you're younger than 71 years old, and here is, I touched on this earlier when I talked about starting an RRSP when you're 25 years old might be considered betting against yourself, because at 71 years old, all of your RRSP savings are going to be riffed, and they are going to start pensioning back into your hands. And as we talked about, RRSP money is completely taxable as it comes back into your hands. So if you're 71 years old and you're still cranking out $125,000 or $150,000 a year in earnings, and now your RIFs are going to start coming in at another $100,000 in your earnings, then you're going to pay top marginal income tax well into your future, and there's not a whole lot of us out here that are going to cry for you, because good for you, you've been fabulously successful in life. So, and this is coming back down to if the current tax rate is greater than or equal to the expected tax rate at retirement. That, again, is just what I talked about off the top about RSPs, that you won't really save tax on your RSPs unless it ends up that you're making less income when you draw them out, when you turn 71, than you are at the time that you put them in. So, when would you use a TFSA? Well, the TFSAs are far, far more flexible. So if you have short-term goals, long-term goals, medium-term goals, the TFSA is the investment vehicle and savings vehicle to be using. Keep in mind, anything you can do with self-directed RSP investing, you can completely self-direct your TFSAs. I want to say that. I'm not discouraging people from using advisors. You need to know your own, call it emotional investing strength, right? So for instance, ask yourself this question: this spring, if you had a couple $100,000 sitting in RSPs that you watched the bottom fall out of, would you have panicked and pulled the trigger and sold everything off back into cash? Because probably you should have a financial advisor if that's the approach you took, right? You make things very difficult for yourself when you take an approach like that, because now you've done the huge faux pas of investing. You've bought high and you've sold low. And the only way you're going to make your money back is if whatever you sold low actually is going to go lower. And, depending on what kind of stocks you own, that might be exceedingly unlikely. So there's lots of opportunities there. Do you have TFSA space? Well, if your TFSA is maxed, again, you're probably not really watching this video, are you? So, and you need to be at least 18 years old. I have that in here because RSPs don't have any such limit. Theoretically, you could start contributing to your RSPs when you were 2 years old. So there is no minimum age limit, but there is a minimum age limit for participation in the TFSA. But from that point on, it is cumulative, year on year on year on year. I should mention that about RSPs too. Your RSP contribution room is cumulative, year on year on year on year. This is very important when the young people I'm talking to are maybe 35 instead of 25, and they're thinking, oh, did I lose out on the 10 years that I wasn't investing? No, you haven't lost. You can catch up if your earnings are high enough to get you there. So your current tax rate is lower than or equal to the expected tax rate. This is when you're betting you're expecting to keep making more and more and more and more money. Sheltered income from your TFSA is kind of good to have. The other straight up reason is your RSP maxed out already. You still got money hanging around. You want to do something with it. Again, you're not going to get a lot of sympathy from your friends and neighbors on this one. It's a good for you situation, and you should take advantage of it. Non-registered money. So keep in mind what I said when we were talking about what is a TFSA. Your TFSA is a tax shelter. So if you have earnings accounts outside of your TFSA that you have room in your TFSA for, you are taking a tax liability on those earning accounts that you don't need to take. You could be putting them into your tax shelter account, your TFSA, and then the earnings would be completely tax-free. So I think there's some, some people's stance on government issues that tie into this, and I can't advise people that if you're believing seriously in government conspiracy against you, then maybe nobody's going to convince you to register anything. So I'm more interested in seeing people have comfortable retirements that, Canadians work hard. We all work hard for many years. And I'm blessed that I played my cards in such a way that now in my pension years, I'm exceedingly comfortable. I want to see that for more Canadians. Right? So here's a strategy for younger people. My fun strategies for people my age were already passed, but I can't cover everything you can do by manipulating these accounts in one little session, but let's say you're 25 years old, you just finished university, you've got a good job now, and you're knowing that you're planning to buy a house and have a family and do all those things that your average Canadian citizen expects to be able to do at some point. So as soon as possible after you're back and working, and when I say as soon as possible, I literally mean before your student loans are paid off too. I mean, you do have to pay off your student loans, and you should definitely prioritize that. But start slipping a little bit of money into your TFSA, right? And if you don't want to manage investments yourself, then put it into a managed vehicle, right? Get some advice from your tax advisor or your accountant, or even your banker can give you some pretty reasonable advice on how to do this. Then the next part, step 2 here, this takes a little bit of forethought and a little bit of planning. The year before you buy your home. So let's say you started this at 25 and now you're 35 and baby's on the way and you're going to buy a house. So you need to know that well in advance. So that year, you're going to flip all your money out of your TFSA into your RSP. This perhaps will be the very beginning of your RSP. You're going to get a big tax return from that, right? I'm going to assume that in 10 years, you've socked away a substantial amount of money in your TFSA. You can then, 90 days after you make that RSP, you can pull the money currently under the HBP program. to purchase a house. Then you can use the HBP withdrawal and the tax savings from having started the RSP as your down payment for your home. And at the same time, you're now already locked into repaying the HBP. So you've managed to ensure the future success of your RSP by having done it this way. You've developed a lifetime savings habit, and you're continuing on that savings habit. And trust me, when you get your first home, continuing on your savings habits is a challenge, right? That you suddenly have a bill that you haven't ever seen before. So the HBB can actually help you, because when you come out the other side, when it's fully paid back, now you have a home, and you have an RSP, and you are on the right track to reaching my age, with an expectation that you're not going to get to pocket a whole lot of old age security. Because trust me, you don't want to be pocketing old age security any more than you want to be pocketing welfare checks. So the key point, I'm in the way of my key points. Remember that success is a simple arithmetic equation. What's your rate of return? How many years are you invested for? That's going to tell you how much money you're going to have, right? You can't do that much, even in a self-directed investing account, to change your rate of return, right? I mean, yeah, you can, maybe you're doing 2 3/4% when everybody else is doing 2 1/3% or something like that. But it's a limited, but what you have great amount of control over, what you have absolute control over right now and here today, is the time that you have your money invested. And the way you have control over that is you start now. So take action, start now. And you'll be a lot happier when you reach my age, because you'll be able to do things that you want to do instead of worrying about making a living. So for MCR Accounting, thank you for listening. You can get further help and assistance on any of these things. Look us up on our webpage or our Facebook page, and we're always willing to help people understand how to make a better future for themselves. So thanks again, and have a nice day.